Hi, and welcome to the Veterans Day edition of the Macro Show, where we talk macro and try to make sense of markets. And I don't know, well, they kind of made a little sense today. I'm your host, Steven Van Metre, and before we begin, I want to thank all of our veterans for their service and their families for your sacrifice. It really means a great deal to me and our country, and we salute you. Now, in today's edition of the Macro Show, we've got some economic data to look at, but more importantly, you are going to become an expert in the Senior Loan Officer Opinion Survey. You say, well, wait a minute, Steve, I thought we did that on Monday. And we did. And as some of you pointed out very nicely overall, which I do appreciate, I screwed something up. And in the process of screwing that up, I actually found out that I had been misreading the charts, which, guess what? You probably have been too. And once I figured out how the charts work, there was some discrepancies. When I looked at the charts and I had my thesis, there's some parts I'm like, man, this doesn't quite make a lot of sense, but I got to go with the way it works. Now that I understand the charts, it's even more firepower for the thesis. I mean, it's awesome. You're going to love it. You're going to become an expert on this. You will amaze your friends with your knowledge of the SLOOS. And yeah, don't worry. Your friends probably won't care. We're going to talk about the 10-year Treasury auction, where we've got the CPI coming up to touch on. We've just got a jam-packed show of things for you. So let's get right into the economic data. Now, there isn't a lot. There's a couple things I want to point out. On Monday, in the evening, we had China CPI year over year dropped to 0.5%. For China, this is low. Their inflation rate tends to run much higher, and this is low. Look at producer prices. This is coming out of factories in China, was flat at minus 2.1%. So if you're looking for inflation in the U.S., which would be goods and services, well, probably not services coming out of their factories, goods coming out of their factory, being imported to the United States, it tells you there is no pricing increase in the PPI coming out of China. Moving on to Tuesday, a couple of points of interest. We have the Redbook weekly retail sales, which Chris Dark and I think one other person actually followed this. It came in at 1.1%, down from 3.2. If you adjust this for inflation of, say, 1.4, which is where it's currently at until tomorrow, you actually see there's a negative print here. And if you zoom into the Redbook data, and we'll change the chart here a little bit, and let's make sure, that we can see that. We'll close this out. Yes, this is an ad-supported show for those of you who keep asking. You can look at the chart here and see that retail sales are nowhere near, and again, this is same store, brick and mortar retail sales are nowhere near where they were pre-pandemic. So if you're looking for the surge in consumer demand and all this pent up demand, well, it came and went. It's not there. Let's go back to the data. We've got the job openings and labor turnover survey came in slightly below expectations at 6.436 million jobs. Let's take a look at it real quick and see what we can glean from it. And the answer is it's on a downward trend. And I'll zoom this in so we can see it a little bit more. You can see it's on a downward trend. This is not a positive sign. Former Fed Chair Janet Yellen, this was her favorite statistic because as far as she was concerned, if there were a lot of job openings, well, that meant people could get hired. Well, what we're seeing now is a rolling over trend, which we've seen in the participation rate. We're seeing this all over the economy in the data, that the economy is rolling over, as I said it was likely to do. And that's before we are heading into the winter season, and we're seeing these case count numbers rise. All right, let's look into today. Because of Veterans Day, the major economic news is being pushed back to the crude oil data. If you're looking for the EIA data, it'll be out tomorrow. Mortgage applications fell 0.5%, while 30-year mortgage rates, I think, hit a new all-time low, or very close to it at 2.98%. So even at these ultra-low interest rates, we're still not getting mortgage demand, which we can guess what we're going to see on Friday's H.8 report will likely be further contraction in credit growth, which is not good. All right, let's move on to the SLOOS data. And I want to preface this is I screwed up, and I apologize to you, and I've had something wrong, but I want you to see where I got it wrong and why it did bother me on Monday until I got emails and messages and Twitter things about, hey, I think you goofed this up. And it was not intentional. I want you to know that. You got to understand, as I go through this data, if I was intentionally trying to mislead you, I wouldn't actually show you the website where you could go read it yourself. I mean, it doesn't make any sense. So, we're a community here, and I value you. Even if you disagree with me, I still love you, and I value your input, because together we become better investors, and that's what our goal is here. Let's look at the SLOOS survey. Now, I'm not going to go through this again, but we know from the report it said that it tightened lending standards across commercial and residential and all of that stuff. And we can even go and look in the data, which we did not do. And here you can see, large and mid-sized firms tightened somewhat. Yes, all respondents that did remain unchanged. So there was net tightening. How about small commercial firms? Net tightening. And you can go through here at your leisure if you want. Now, when I pulled up the graphs, we saw this, and this confused me a little bit because the report said net tightening. The graph says, looks like easing. Well, and then I pull up my charts. Now, here's where things went wrong. And if you have a account at the Federal Reserve database, which is free, you can save your graphs. And there's an option when you save it that says, the next time I open this, I want the most current data, and backwards to whatever point you pick. I generally save all of my graphs in the same form. Now, for those who do use a FRED database and do have an account, you also know what I know. It doesn't always work that way. So when you open a graph, sometimes it doesn't move you to the current data. And so when I open this, I do a lot of the things for the show literally right before I record. And as you probably figured out, I don't edit. So it's live to me and it comes out to you. There's zero editing involved. So when I open this report, it opened like this, and I moused over and it said Q3. Now, well, that makes sense to me because the report for SLOOS just came out. This is October, somewhere on here. October 2020. It would imply to me that we're looking back on the third quarter. So when I saw this, I said, wow. And I went back and I looked. I said, well, something must be wrong, and they'll fix it in the future. Well, what was wrong is for some reason they call this the Q4 report. And when you slide it over, as again, many of you pointed out and even sent me charts to, you see what appears to be easing. Except it doesn't work that way. What you're seeing in this chart is it charts like a diffusion index. So what is diffusion? Remember we go through those PMI reports and we talk about how on a month-to-month change, you have to go backwards in time and look relative to where it is now, because a 50 on the PMI report just means no change from the prior month. So when we saw the economic data, it crashed down in May, and then shortly thereafter, it went up to 50. The 50 just meant no change from the prior month. So a 50 doesn't mean it's good. It means it's bad because it didn't go up. Well, this is charting like you would expect a diffusion index. I didn't actually know that. And now you do too. So let me tell you how to read it. When you see over the zero bound, that denotes tightening. So for example, we'll go back to the great financial crisis. It's very obvious, tight. Now the logical conclusion here is, it started to ease in Q1 of 09 and Q2 and so on and so forth. No. It meant it tightened at a slower rate. So all these moves down, because they're over the zero bound, is still tightening. It's just tightening at a slower rate. It wasn't until Q2 2010 that it started to ease. But again, the amount of easing from all of that tightening was very small. And it slowly eased. So just because it's down here doesn't mean it's massively easing. It is easing, but it's coming off really, really super tight conditions. And then we almost have a double dip recession, and you notice that this goes back up. It tightens again in 2012. So this is very interesting because I was misreading it like most people do, that a move down means it's easing. And it would make sense, right? You think, all right, well, the market bottom in first quarter 09, and this makes sense that banks would start easing after the peak, but that's not the case. They were tightening all the way through Q1 2010, And at that point, there was no change in the prior month or quarter. So that's how you read this. Now, this is really interesting because when you overlay Treasury yields, one of the issues I had was, well, how did rates go down when we'd been easing this whole way through? But that's not how it works. Remember, right? Now it makes the thesis even more powerful when you really understand this. And I know some of you complain about me moving my mouse. I just can't help it. I'm just addicted to it. So here we go. It's tightening all the way down here. So rates back up. This is where, so we see this crash in yields where real yields rise, and then real or inflate. And when I say real, I mean inflation adjusted yields start to come down, and then they roll over and they don't bottom until 2012, Q2 2012. And why is that? Because we're coming off this extreme tightening. And even though the banks are easing lending standards, they're still too tight. And they figure that out. They tighten standards up again. And it's not until the Fed really comes in, and you kind of see now where the latter phases of QE come in, as the Fed realizes financial conditions are too tight. And it's at that point you start to see rates come back up. But even though, again, financial conditions are still relatively easy or loosening, rates still go down because they're too tight. And then, of course, we see financial conditions tighten. And here's what I find very, very interesting. If you look at this peak in yields right here going into October of 18, you'll notice the next quarter, I'll move my mouse off, what happened to lending standards? They tightened. So you can see this great relationship between Treasury yields and banks tightening lending standards. So if someone is out there saying, well, banks want higher rates. Well, yeah, of course they want higher rates because they make more money on the spread. That's the whole point of how banks make money lending out money. But when you look at this chart, it tells you, as a matter of fact, that banks do not want higher rates right now, because if they wanted higher rates, what would they do? They would lend out a lot of money. And all that money getting lent out in the economy would start moving around, create inflation, and therefore lead to higher yields. So if someone's like, yeah, well, they totally are going to massively ease. No, they're actually not. I'm going to prove to you why they aren't. But this is evidence why banks want lower yields. And does it start to make sense why they participate in QE? Because a lot of people still wonder, why do banks do QE? Because they want to. Why is the fastest growing part of a bank's balance sheet right now Treasury and agency securities? They want lower interest rates. They're doing everything they can to tell you we want lower interest rates. And by tightening lending standards, you see who controls who. Remember I said the banks control the Fed? You see it right here. They're tightening lending standards, and then the Fed responds trying to ease them. It's all right here in the charts. Now, when I also pulled up the dollar, because I figured some of you want to know, well, how's the dollar look against lending standards? Well, you can see when lending standards tighten, the dollar tends to rally because there is usually an insolvency event or a deflationary crash. And why would that make sense, and why does that occur? Because there's a dollar shortage. And why aren't we seeing that now? Because of all the fiscal transfers and people being sent home. As I said, that was my big view of why. It wasn't QE that caused the dollar to go down, because you can see QE through here, it went up. Why did it go down? Because there wasn't a demand for dollars. But as we go forward, and people are not getting their jobs back, and there's no more stimulus, or at least not till next year, and even then it may not be what people are hoping for, and their loans come out of deferment, and all that good stuff is happening, guess what happens to dollar demand? It tends to rise. And this makes, again, perfect sense, because where do we get dollars? How are they created? When people borrow money. And when banks tighten lending standards, as we see in the H.8, when we see the contraction in credit, that means fewer dollars, or actually dollars are being destroyed out of the economy. It makes perfect sense. And someone asked, hey, would you overlay the stock market? And I've done this before, and I'm happy to do it again, because it validates that as lending standards are tight, usually that's bad news for stocks. And even coming into 2010, where we, again, the stock market almost double dipped there after it bounced off the bottom, lending standards finally eased and allowed that the market to go up. And you can see when lending standards tighten, generally it is bad for stocks. And here they are at super tight, and everyone thinks this is a beginning of bull market. Historically, there's no evidence, and you can see it in this chart. There's none to support that. But let's keep this ball going, because again, you keep hearing people say that, oh, banks really want to lend. They don't. I'm going to prove to you when and why they tighten lending standards. Ready for this? Let's go to the next chart. This is the 4-week moving average of initial unemployment claims. Now, before you panic and say, why are you cutting the chart off? It's because there's such a skew from the pandemic that you won't be able to actually see the data here. So I backed it off so we can look at it. And what you see generally, as claims start to rise, or in this case, the bank started tightening standards and claims started to rise, that they didn't back off. In fact, banks didn't back off until claims got closer to 360,000. We're nowhere near it. We're at 750 right now. And look here, you see banks starting to tighten lending standards mainly because unemployment is flattening out. And then all of a sudden, unemployment claims start to rise. And guess what? Banks start to back off as claims are sitting here in this sub 500 number. And then they realize, no, that's not enough. It's, again, that 360 number seems to be pretty consistent. Now let's move forward with this chart so you can see where we're at now. And lo and behold, you can guess why banks are not going to go out and lend. The 4-week average of moving claims is 787,000. I mean, think about it. Do you want to go out and lend to people that are unemployed? They like their money. They like you to do that. Because what does the risk banks have? People not paying them back. That's the only thing they care about is, I'm going to lend you money, Steve, and I want it all back, plus the interest. So why would the banks go out and lend when there's 780,000 people on a 4-week average of filing initial claims, when there's fears that there will be more claims coming forward? If you were a big bank, would you go out and lend? But yet some people think, oh, well, the banks are going to totally want to lend. They care about getting their money back. No different than when you loan something like a friend or somebody or something that you own. What do you care about? Hey, I want it back. Banks care about that too. All right, let's go on to the 10-year Treasury auction data. Someone mentioned, Steve, you're hiding things because you didn't want to talk about the lack of foreign demand. I have talked about the lack of foreign demand repeatedly. And I will prove it to you again why it doesn't even matter anymore. Here's the 10-year Treasury auction. It was an outsized auction of $41 billion. Foreign bidders came in a little over the level they did last month, but due to the outsized amount auctioned, the percentage of the take from foreign bidders was quite a bit less. It was from like low 60s into the, I think, low 50% range. What I do find interesting is, look, primary dealers bid almost $60 billion on a $41 billion offer. Now, some said, well, I thought primary dealers had to bid. Well, they do, a minimum bid. And that minimum bid, I guarantee you, is not $61 billion or $60 billion. It's not. Now, why doesn't this, why am I not hiding something about this foreign purchase? Because how do foreign central banks and foreign countries get dollars? Through global trade. So what do they do when they get a lot of dollars? They recycle them into U.S. Treasury debt. Think of it as a savings account. So why aren't foreign central banks buying more Treasury securities? Because they don't have that many dollars. We're in a dollar shortage. Why? Because global trade's been in the toilet. The global economy's been in the toilet. So they're not bidding big on these auctions because they don't need to. They're short dollars. They need dollars, so they don't need to go buy a lot. It doesn't imply interest rates are going up. It implies the exact opposite. Whoops. Well, that too. It implies the exact opposite because it's telling you there's a global dollar shortage and financial conditions around the world are tight. And if we look at federal debt held by international investors, you can see 2015, 16, 17, pretty flat. They really weren't buying much. And it wasn't until here in 2019, first couple quarters they bought, and they're flattish. Yeah, they're up a little this year, But overall, there's not this big demand that we see during, oh, wait, look, expansions. Now, this recession here, for whatever reason, they bought, this is more like it. So the notion that there's a problem here, unfounded. Now, tomorrow is a CPI report, which is very interesting. I think it's going to be lower than last month. So it's at 1.4. I'll let you pick. I'm guessing 1.3, 1.2 is where it's going to come in. And a lot of people still think that, oh, this money supply thing leads to higher consumer prices. So let's take a look. Here is the M2 money supply on a year-over-year basis. Woo, way off the charts. We're going vertical, Mav. And then we get the consumer price index on the right side, year over year. So they're the same. And we see it looks like the consumer price index is rolling over. But notice this during recessions. Hey, we have a rising money supply in blue. Oh, wait, consumer price index rolled over and went down. Okay, well, maybe in the great financial crisis it was better. Nope. Money supply went up. CPI went down. Hey, it's funny kind of how that works most of the time. Now, we have going back to this recession here where they were in sync. But since then, tend to get the opposite. So for those of you betting on higher inflation or deflation, you can still like the video either way. Be sure to subscribe. And we'll be back on Friday to go over the economic data. I'm really looking forward to seeing if there's further credit contraction, because I expect there will be. And so with that, I'm Steve Van Metre. I'll see you on Friday. And yes, today, we're going for speed. The content of this video is provided as educational information only, not intended for investor and other advice. It does not to be construed as a recommendation or solicitation by a security financial instrument or participate in particular trading strategies. Video was prepared by Steven Van Metre personal capacity. Business best with video that do not affect the video outlets and advise Inc. or Steven Van Metre Financial.